Good afternoon. My name is Joseph Schilling, and I am here to tell you why you should buy Walmart. Now, everybody knows Walmart, but Walmart, as a quick overview, is a retail store which is a supercenter. Specifically, what that means is that they have a great assortment of products. They do groceries, they sell electronics, they sell clothing, they sell hardware, and even Sam's Clubs, they have mechanics available to help you out. Walmart, as you can see, has outperformed the S&P by quite a bit over the past year. They have also had sales rise in the United States by 3.4%, mostly boosted by their online purchases. Now, here's the interesting part. They are investing heavily in e-commerce. And because e-commerce is such a capital-intensive field, not a lot of companies have been able to keep up. Walmart is the one that's been winning the race. As you can see, their retail store services like pickup, grocery pickup, same day or next day delivery on products have grown 40% as of January 31st of this year. What Walmart has also done is that they've added more selections to their products with higher margins, such as apparel and home decor. They have higher margins because they're just easier to manufacture, and people like cheap clothes because they can buy more, right? And especially if they could get next day delivery or same day delivery, or pick them up at the store and then try them and send them back for free and then get another one. Something that Walmart has been pushing very, very heavily. I'm going to do a quick Porter's Five Forces analysis to go through what makes Walmart such a strong firm in its field. As for industry competition, Walmart's competitors are more focused, they're more niche. Take, for instance, Costco wholesaler. They are competing with a segment of Walmart, which is Sam's Club. Lowe's, for instance, are competing with their department store. Of course, they are not comparable in size because it's just a segment of business. However, they are direct competitors. So the fact that Walmart is a big supercenter, I guess retail store conglomerate, if you will, to not overuse supercenter. You can see that it has competitors across all of the areas that it operates in. Barriers to entry and new entrants into the industry. It's very hard to become a very large retailer, simply because it requires a lot of capital, whether that be e-commerce or retail. The supply chain logistics are hard and very capital intensive to operate and to produce and buy products as an intermediary, especially with Amazon. And like I said, even if they did enter the market, they would have to beat Walmart on prices, which is very difficult because of this next point, the power of suppliers. Walmart has had relationships with its suppliers for decades, and because they've been around for such a long time, they've been able to maintain those relationships and be able to order in bulk at lower prices. They've been able to increase their margins because of that, and they've been able to stock up more on products that are very popular, which increases sales, especially online. The power of customers is extremely important because people know Walmart. Like I said, since it's been around for a while, you can see that the customers are loyal to the brand as long as they give them what they want. For instance, grocery pickup at the store, next day delivery on the clothing that they want to buy, availability of the products and variety that they want, which is exactly what Walmart is doing, which of course justifies such high growth rates, 40% at the beginning of the year and 3.4% in all U.S. stores. As for the threat of substitutes, because they're a retailer and they do have their own brand, Great Value, I believe it's called, there may be a threat of substitutes, but like I said before, people like Walmart. People like Walmart because Walmart gives the customers what they want. And when a firm gives customers what they want, they always come back, especially if they've been around for so long and they know the store, they know the people there even, which also translates to the employees who want to stay and are actually paid very high wages. $15 an hour, I believe, and that is supposed to grow. But I digress. Next point is going to be some investment metrics. It's P of 21.32 and its estimated PEG of 3.07. It has a dividend yield of 1.97%, which is great, and the industry growth rate is 3.1% from 2017 till today. And I'm not sure if you can see, but I built this chart in Bloomberg with Kroger and Target in comparison to Walmart. And if you can see Target, it took a very huge dip and has been underperforming Walmart for a while now, with a few occasional spikes, but not really. Kroger took a huge dip from about $35 or something to $25. Took a huge dip and has been underperforming Walmart ever since. Like I said before, Walmart is leading the race in the e-commerce and the online sales. Competitors can't keep up with it. As for my DCF, I made a few assumptions. I used the beta, the 6-month average adjusted beta from Bloomberg. I used the 30-year Treasury, U.S. Treasury, as my risk-free rate to calculate my WACC, and a terminal growth rate of 3.3%, which is the expected compound annual growth rate of the supercenter industry, given by Statista. It lays it out like that. At this valuation, we can see that Walmart has an upside of 19.54% at $122.24. And this is being extremely conservative, calculating a WACC of a little bit over 6.5%. And we can see that even today, Walmart's underpriced. And it's because it's poised to grow so much, especially in the online retail space. The two ratios here, EV to EBIT and EV to EBITDA, the multipliers, I use Target, Kroger, and Costco, like I mentioned before, because they compete with several segments of Walmart. Target is also a supercenter, but it is much smaller in size. Dollar General has very high margins, just like Walmart does, especially with their own brands, and that is why that is also in there, and they are very comparable in size as well. We get a 15.67 multiplier for EV to EBIT and 10.93 for EV to EBITDA. The first ratio gives us an upside of 74% at $178. That's a lot. However, we can see a more conservative approach to EV to EBITDA with 22.2% upside, which is much closer to the DCF model. And if we were to average them out, I would prefer the DCF and the EV to EBITDA, which would average out at about 123. But if we average all three of them out, it comes out to $41, which is a great buy because it's sitting at about $100 right now. Now, to wrap up really quick, I want to say Walmart is investing heavily in its online retail space, something that none of its competitors is able to do because it's so capital intensive. Number two, they've increased products that have higher margins, which means that not only their sales are going to grow, but their profitability is going to grow as well. They have introduced very great projects such as same-day delivery or next-day delivery for groceries and apparel, something that only Amazon does as of today, and they don't deliver it next day. You have to go pick it up. Walmart delivers it to you. Like I said, they give them what they want. So I urge you to buy. And like I said, Walmart's been around for a while. It's not going anywhere, and it's winning the e-commerce race in the retail space. So thank you. These are my references in case you'd like to fact check me, but thank you.